Thanks a lot, Mai, and thank you everyone for joining us today on this Eide Bailly Healthcare webinar. So I'm going to give just a really brief introduction as we have a lot of great content to share today. And joining us today for the presentation are Michael Anderson and Casey Chapin from Highline Capital Management. And they're a registered investment advisory firm that provides a lot of great services and investment advisory services to clients of Eide Bailly, and who had a great success and track record. So as we've seen an interesting year in the markets in 2022 and the recent rises in the interest rate environment and other market movements, we thought this was very timely information to get out there for healthcare provider clients and other entities out there that are interested in this topic. So with that, I'm going to turn it over to Michael Anderson to kick off the rest of the time we have here today. As mentioned, please, if there are questions, use the Q&A function or chat functions in the webinar today. So with that, Michael, take it away.
All right. Thank you very much, Jeff. Appreciate the opportunity to talk about healthcare investing and the opportunities that do exist. And I want to have the audience think about if it's time, for a SWOT on the investment side of the equation. So the topics that we're going to cover today are sixfold over the course of the next 50 plus minutes. We'll give an introduction about Highline and kind of its journey. We'll talk about strategic opportunities for healthcare providers in the investing marketplace. We'll talk about good and bad institutional investors. We will also review an investment operation of what are some best practices and how that should be shaped and look like. Then we'll review a few options and opportunities in the marketplace, and then discuss further about what a SWOT analysis may bring to your organization. So first, as an introduction about Highline, I think we best call it a happy accident of the last 20 plus years. And it really, I think, highlights and emphasizes the importance of non-operating margins. And so as we think first of the team that was instrumental in bringing us to this point, started working with Jeff and Ralph about a year ago, and they certainly have identified the economic opportunity that does exist. And then we have Casey Chapin that's also on the call that will be participating and talking through some of the best practices that we have in place and how we can perhaps be of assistance. But as it relates to the story about Highline and the happy accident, it really started with a hospital about 20 years ago where I was a CFO at. And we just continuously tried to make improvements in the investment, operation. And, using days cash on hand as kind of a metric in terms of where this organization was 25 years ago, where it's at today, despite all of the market challenges that have been faced during the last 25 or so years, there's been some fairly impressive results. And so just kind of wanted to share a few, kind of incremental steps and things that contributed, and it was kind of a compounding effect of things that occurred over time. And so I did have some institutional investing experience at a Essentia Health System in the late 90s. And this was certainly when the .com environment was going hot and heavy, if you will. And they were following a traditional kind of consulting based model. And my background is being introduced to Warren Buffett through a book in 1995. And I had different ideas and thoughts about institutional investing and intelligent investing and those sorts of things. And so when I became a CFO of an independent health system in 2001, out of the gates, I decided I was going to spend at least 10% of my time on the investment operation. At that time, the organization had about 35 million in net revenue and about 20 million of investment assets on the balance sheet. But slowly, year in and year out, started to make some incremental change, and it started really with the financial planning process and asset allocation, and then really focusing on risk and what does that mean. It evolved into identifying certain investing in philosophies and principles that should be embedded within the policy to have a unified voice. By 2005, I was directly having discretion over a percentage of the portfolio and making buy-sell decisions on bonds and stocks and things of that nature. And fast forward, to 2007, and the realization at that time was we had two businesses of equal size. And by 2007, revenue had increased from 35 million to 50 million. Investment assets had increased from 20 million to 50 million. So we said we really have two businesses, and one is lacking full-time, executive leadership. So the decision was made at that time to split the CFO job into two. And I gladly volunteered for the chief investment officer position that was newly created in 2008. And so I stayed in that role as a one-man investment shop, if you will, within the health system for the next 10 years. And we continued to find ways and ideas and things to implement and become more advanced in terms of our institutional investing skills. And in 2018, 10 years into that position, as we were looking at opportunities to continue to grow and develop, it was time to develop a team. And so the decision was, do we stay in-house or do we go outsourced? And it was decided to go outsourced. And so Highline Capital was born in 2018, and then started building a team. And Casey Chapin was the first individual that came on board to help lead the process. And right now we have 7 individuals that make up the Highline team. So we're 4 years really into providing outsourced, we would call, chief investment officer services to healthcare. Nearly 100% of our assets are healthcare based, with our background being a former CFO, and understanding a lot of the nuances that exist on the healthcare side of the equation, I think is beneficial and advantageous in trying to marry together the investment operation with the mission-based operation that the services are being provided for, whether it's nuances on Medicare cost reports and cost reimbursement and how realized gains can impact those elements, whether it's the sensitivity of local politics, whether it's a government county city owned hospital that might have certain limitations, and those sorts of things. And so we have a lot of background on things that can help bridge that gap between the two businesses. And then lastly, the kind of a foundational element is an open platform in terms of trying to add without subtract. One can work with any custodian, one can work with any investment strategy manager, et cetera. And so it's not a closed, sort of platform. All the pieces of the operation isn't designed to be merit-based and stand on their individual legs. So transitioning into the second topic on the agenda, let's talk a little bit about the strategic opportunity. And I think describing it as an old CFO would, hidden reimbursement. And so if one peels back the layers a little bit, perhaps there's an opportunity to make additional money, especially in this environment where healthcare providers are at the brunt, facing the brunt of the inflationary effects. Your revenue obviously is not keeping up as quickly as the expenses are, and there's certainly a lag that will be recognized by payers on that side of the equation. And so margins are no doubt as challenged today as they have been in the last 20 years. But when we step back and look at the average small hospital in the nation, and this is using S&P data of a triple B profile. And going back 20 years, and let's just compare 2001 with 2021, and operating revenue, has grown about 30% in that, 50% in that time period of the last 20 years. Operating income is still in the 2-3% margin perspective, but days cash on hand has increased significantly, and cash and investments have tripled in size. And so the differential between the revenue growth and the cash and investment growth is the cash and investment growth has increased 50% more in that time period than revenue. So point being, 20 years ago, the importance of the investment program, if you will, for the average provider hospital was less important relative to today. As we look at the Midwest relative to the national profile, again, using the S&P BBB metrics, the operating margin of the rural Midwest is better than the national profile, but the non-operating margin is half of the national profile. So that clearly demonstrates that in the Midwest, and that's really defined as Minnesota, Montana, North Dakota, South Dakota, Nebraska, Iowa, there is significant opportunity for the average rural Midwest provider to find additional economics generating from their balance sheet. This is a busy slide. It's attempting to prove which margin is more important if you had to pick one. Obviously, you'd rather have both margins, operating margin and non-operating margin, being executed at a high level. But all things being equal, the non-operating margin is actually more important from improving the economics of an institution. And so the three columns here, the first one is a baseline, and this is a 20-year comp in terms of, you know, a certain growth profile, certain margin profile, et cetera. And if one has no change and no improvement, right, your days cash on hand is roughly going to be consistent at the end of 20 years than when you started. If one were to improve operating margins by 2.5% year in and year out, one would increase days cash on hand approximately 38% with the assumptions provided. If one improves non-operating margins 2.5%, the days cash on hand improvement more than doubles. And why is that? How is that, you know, how is that possible? Well, there's two reasons. The first one is compound interest. And when you have an improvement on the investment operation side of the equation, you're going to make more money. And oftentimes that money is retained on the balance sheet. And then you can make more money on money, and money earns on money, et cetera. And that's the element of compound interest. That doesn't exist on the operating margin improvement side of the equation. You can have improvement, but if your investment results are still subpar, you're not able to compound your income like you could otherwise. The second reason is the improvements made on the non-operating margin or the investment asset side of the equation are truly continuous enhancements. They don't go through the same cycles that perhaps the operating margin initiatives do. You know, we do a lot of work to improve operating margins, and then we have this headwind called inflation, or payer contracts, or, you know, new services, or whatever the case may be. And it's probably impossible to maintain consistently high or desirable operating margins year in and year out. But when one builds an investment program and operation, one has the ability to continuously have better consistency in the results that is built over time, therefore providing the second reason why, in our opinion, non-operating margins is actually more economically important to focus in on. Transitioning to some good and bad examples about institutional investing or investing in general. Smart people do dumb things. I know that's not a shock. We probably see it every day. That judgment is coming from what was a study done by Carl Richards, and it's called the Dalbar ratio. And if an investor just invested in the S&P 500 index, and you put $1,000 in the index and you left it there for 10 years, the return of the S&P index and yourself would have been 6.8% over this 10-year period of time. And over a 15-year period of time, the return would have been a 5.4. But what this Carl Richards did was he was able to calculate using Morningstar data what the underlying investor's return was. And it's summarized in the bottom right hand of the page. The underlying investor in that same 10-year period of time, on average, earned 4.3%. It's a 2.5% differential, and then earned 2.2% less over 15 years. So how is that possible when the underlying index is doing 6.8%, but the average investor of the index earned 2.5% less? Well, it's due to a lot of natural behaviors that humans have in terms of short-term thinking, pursuing, chasing returns, selling out if there's been a decline. All those sorts of elements cause investors to ultimately, buy higher and sell lower when they're trying to outsmart the market, versus the investor who says, "Look, I can earn this return if I do nothing." And earning average is actually an exceptional return. And so the enemy is often within us on an individual basis, but this is also true. This behavioral gap exists for institutions as well. And so a couple of examples that we put together, the first one being state pension investment systems. South Dakota, Wisconsin are at the top of the 50 states in terms of their funding ratio, their returns, the investment operation, et cetera. And then on the not so good side of the equation, Illinois, New Jersey, Kentucky. But if we compare 10-year returns of South Dakota versus Illinois, it's a 2.3% differential, similar to what was shown in the Dalbar ratio. And then let's take a look at Ivy League schools, Yale and Harvard. Lots of smart people, no doubt about it, but Harvard does not have an effective investment operation relative to Yale. And there was more than a 3% differential from a return perspective over the course of this 10-year period of time. So digging a little deeper in terms of what lessons can we learn from Harvard and why they did so poor relative to Yale. First one was a leadership problem. 5 CIOs in 10 years. They may have developed a long-term plan and strategy, but it was never fulfilled. It was not followed through on, because that kind of led to problem number 2, no commitment. They had different ideas on how to invest for the long term, and long term was 2 years apparently on average. Problem 3 was a heavy reliance upon illiquid strategies. And so like in 2008, this is even before the measurement period, Harvard had to borrow significant funds because the majority of their assets were illiquid. They needed the cash for their operations, et cetera. And it was not a great time to be having to leverage up while markets were extremely chaotic in that environment. Problem 4, misaligned incentives. The staff was rewarded for short-term performance. And so those are kind of 4, I think, easy observations in terms of the difference between the program that Harvard had versus Yale. When we study other institutions, whether it's healthcare, non-healthcare, et cetera, here's 5 more examples of where people go wrong, or where institutions go wrong. Problem 5, no written criteria for selecting or for making decisions, whether it's criteria of a philosophy, criteria for philosophies, criteria for selecting managers. There should be several elements that are specified and outlined within the policy that provides the specific guardrails and the rules of the road of what one is trying to execute. Problem 6, agents typically are not fiduciaries. And you have the agency problem that does exist. A fiduciary is the highest standard in terms of attempting and seeking to put your institution's interest first. An agent just has to meet a lower standard of best interest or suitability. So there's natural conflicts that are created from most of the relationships on the consultant side of the equation. From a CIO perspective, an outsourced chief investment officer perspective, that should only be a fiduciary-based relationship to eliminate the conflicts that can exist. Problem number 7, many people try to minimize volatility of equity assets, that then they seek to do so many different strategies and solutions, and they often end up paying a high price. They often end up increasing risk in other areas that are unintended. There's all sorts of problems that can be created when one tries to tamp down the natural volatility of certain assets. Problem 8 relates to governance oversight. And one of the big things is if there's an investment committee or a finance committee that is generally um, delegated by the board and the policy in terms of governance oversight, is there adequate, we would call money-minded individuals that understand markets? Sometimes bankers can be great money-minded individuals for an investment program. Sometimes bankers or insurance-based financial service people can inhibit money-mindedness because of the exposure and the belief set that they have embedded within their practice. Bankers, as an example, maybe fear equity because of the volatility. And so one just has to be cognizant of the individuals that represent the governance side of the equation. Problem 9, high fees and total expenses. For every dollar of fee and expense that's a part of the program is one less dollar retained by you, the provider. So there's many more examples, but those are 9 high-level examples of things to avoid at the end of the day after trying to study failure. Oftentimes lessons are better learned and understood by studying failure of what to avoid. So that's the summary of the good versus the bad side of the equation. Transitioning into the investment operation, we're going to cover a number of different topics and areas in terms of, okay, if we have a business number 2, you know, how should it be constructed and how should it be led and what are the activities associated with it? But as mentioned earlier, rural Midwest is better. Must have better consultants in the area that helps out providers. But this is kind of going back to the 2 businesses. Certainly on the left-hand side, the blue bubble is the primary purpose of the business, the mission, providing health services, etc. And the specific things that have to be done and done well to be a high quality provider. And then business number 2, when we think of rural Midwest hospitals and providers, you know, 38 million of investment assets, that bubble is about 80% the size of the first bubble. And the skill sets on the upper right hand side of the equation is different and unique than what it takes to run a healthcare provider entity. And so which business predominantly lacks that executive leadership side of the equation? As we transition into the investment operation and what are the components that are necessary and helpful to run a second business, you know, it's really made up of 4 elements. On the upper left-hand side of the equation, certainly the governance, the board. And the board will often delegate a lot of duties and responsibilities to experts and people more equipped to execute. But they certainly approve the policy. They certainly approve the budget and capital spending and strategy and all those sorts of things, which should be tied into how your investment operation allocates assets, because it needs to be responsive and designed to meet the needs of the individual entity. Certainly the board and wants to ensure policy adherence. They approve policy exceptions, and then there's a monitoring mechanism. And oftentimes you might have a subcommittee, whether it's finance or a separate investment committee, come together to review and monitor the operations on a quarterly or semi-annual basis. On the upper right-hand side of the equation, we have a number of policy and operational pieces that need to be pulled together and defined. So everybody's on the same page. It's the rules of the road that we're trying to execute. And, you know, investing is such an interesting topic in that everybody has some personal experience, and sometimes it's good, sometimes it's bad. Most people have some form of philosophy or belief set. Sometimes it's appropriate, sometimes it's inappropriate, sometimes it's speculative, sometimes it's not. And so a lot of these things is really trying to deliver what we would call a unified voice for the institution. We want one set of rules, we want one set of philosophy, we want one set of principles, we want one set of objectives, one set of risk, all these sorts of things. And this is how the institution as in aggregate is going to be assessed against. and all the participants that are involved in the operation, whether it's governance, management, investment leaders, whether it's external agents involved on auditors or whatever the case may be, everybody has a common identifying purpose and how the operation is constructed and who's making decisions and how decisions should be made. Then it's up to execution from there. And so the policy is the central document that explicitly defines all these things that the board desires to have done. And then on the bottom left, you got the people really that the leadership side that needs to execute, to lead the investment operation, to do the financial planning, the modeling, the risk process, strategy selection, reporting, teaching, all the admin elements that go into it. On the bottom right hand corner, we do have a number of best practice elements that help steer and provide a starting point really for those. So what are the most important things? What are the things that are necessary to avoid what's happening at Harvard or other institutions that may have produced subpar results over a long period of time? And five topics that Highline has identified above and beyond all of the good work that other entities and organizations have identified as best practices. But these are 5 additional things that are not found elsewhere that are extremely important. Understanding risk management, and a lot of investment quote experts will talk about risk and really only talk about volatility. Volatility is only one of 15 different risk elements that does exist that one has to manage, minimize, or seek to eliminate. We'll talk more about that in a couple slides. Connecting mission with investing. Oftentimes, the investment operation acts like an independent contractor. You got this strategic asset allocation based on this theory of XYZ, et cetera. But if you're building a patient tower, if you need, 50% of your assets tomorrow to fund this purpose or this strategy or whatever the case may be, it has to be invested accordingly. So it's really connecting the investing to be responsive to the needs of the mission, the services, and the strategy of the organization. And every financial plan is different. 3, intelligent investing. No best practice talks about intelligent investing. There's a significant difference between speculation and investing, and there's a big difference between various types of investing definitions. The dictionary would say investing is attempting to achieve a profit. Buying a lottery ticket, by that definition, is investing, apparently, for those that attempt to buy a lottery ticket to win big. That's not investing, that's speculating. Investing is, after thorough analysis, after proper due diligence, ensuring that there's safety in the promise of a return on your principal and the return of your principal. And anything that doesn't meet those definitions would be speculative in nature. And so it is a much higher standard in our minds that exist in terms of what truly is intelligent investing. 4, unified set of beliefs. We kind of talked about the importance of that within the policy. We'll talk a little more later. And then the right team, doing made up of the right people doing the right job. So as we think about the chief investment office, our officer, whether it's in-house or out-house, there's really 8 elements that executive leader would pull together. They don't do it all, and it's not a one-man shop or a one-person shop. It is a team. The policy is approved at the board, but one needs to have a coordinator of the policy, asking the right questions, going through the review process, ensuring adherence, all those sorts of things. The financial planning process, the CFO, the CEO, certainly they're leading the process of budget strategy, et cetera. But the CIO will ask the right questions to make sure that the assets are allocated according to the plans and needs, contingencies, et cetera, that the CEO, CFO need to have in place. Risk management. We'll talk more about that later, but you can see the number of elements. Teaching and education ends up being one of the bigger areas. every meeting, one should have 10 to 15 minutes dedicated to learning long-term truisms and principles and trying to improve investment temperament to avoid, those bad decisions, outcomes, et cetera, that can occur even at a place like Yale. And so as it relates to the policy, this provides a few of the specific sections that should be made up and should represent the policy. The unified voice, I think, is underappreciated in terms of importance, but that's the first thing that should be there, because it provides those guardrails, and those guardrails are needed, especially when there's periods of stress, that people can rely upon long-term truisms to make decisions, even though the future may seem more uncertain. Risk management, pool definitions, et cetera. We're going to give a few more examples of some of these things. And so as it relates to philosophy and principles in black at the top, the philosophy that we think is the best discovered yet in terms of defining how, what investing is all about. It's the net present value of future cash flows discounted to the present. And then we have these 7 principles that help shape the attitude of how one can make judgment about that. And so there are certain things that provide insight about how to think about markets. And then there are 4 elements that relate to risk management, of executing the investment decision making. How do you invest with a margin of safety, right? If you invest with a margin of safety, that means you're paying a price less than what something is thought to be worth. And because you consciously do that on every investment, you can absorb bad luck, an environment where things aren't going very well, whether it's inflation or COVID or recession or geopolitical events or whatever the case may be. You can absorb negativity in the future and still not lose money, because that's the most important thing. Continuously assessing risk is a part of that process. And most of the risk really relates to the temperament and the psychology of investing at the leadership level. Being businesslike and managing the operations, being conservative in assumptions. As many CFOs probably can attest, you can make numbers look like anything you want, but are they real? Are they conservative? And then controlling the controllable. Oftentimes we see many people trying to predict interest rates and trying to predict, what's going to happen in the next election cycle, what's going to happen, with, what happens if a natural disaster hits, or war, or the currency change, et cetera. We can't control none of those things, and we can't predict any of those things. We can control our discipline, our education, our patience, our temperament, our security selection, our diversification, our asset allocation, our financial planning. All those things are where we should be spending our time to control. So as we relate, kind of move into risk assessment. These are we would say the top 12 risks. And generally speaking, the temperament risk is probably the area that needs the most time and attention and leadership. And temperament risk is really the collective people at the organization. How do they react to short-term events and to fear and greed and volatility and all those sorts of things? Because there's just natural emotions that we need to work to counteract. And there's antidotes, and the principles are antidotes. Trying to tamp down these natural instincts that often come bubbling up. As it relates to other risks, asset allocation, you can be exposed to liquidity risk or interest rate risk, et cetera. Negative arbitrage, that's understanding, are your returns higher than the cost of your debt? Investment management risk, inflation and losing money. Execution risk. There's many, many more, but this gives a flavor of the primary risks that we need to spend time thinking about mitigating and reducing. And volatility is only one piece of that side of the equation. I'm going to turn it over to Casey and allow him an opportunity to kind of talk a little bit about the financial planning, asset allocation process.
Sure. Thank you, Michael. I'll go through these relatively quickly, but financial planning is so important to the process because it marries, really the overall asset allocation of the investment portfolio to the mission of the institution. And a lot of times that we find when we're onboarding or working with an institution that hasn't been done, and generally they fall into a bucket of 60-40 or 50-50 mix, and it doesn't match, necessarily what we would call what they need for, days cash on hand at the checking account, what they need for funding liabilities in the next year or two, and so on. And so, we've broken it down by funding priority, kind of in the middle here of the page. And the first is really the cash flow, the working capital. How much do you need? Is it 45 days cash on hand? Is it 60? But that's daily liquidity, and that's really the primary objective of that first pool. The second is what we call the reserve pool. That's there to support pool number one, but really that's a bucket of 1 to 3 years, and its primary objective is income and liquidity when needed. And then when you go out farther, we have the intermediate pool that supports the reserve pool and so on. That's your bucket of 4 to 10 years, and the primary objective is income. And then you have the final, the long-term pool, where we would place equity and longer-term investments, and that's your 10+ horizon. And we have those together because we want to first and foremost make sure we can fund the mission of the institution with really the primary 3 buckets. And then the fourth, can be the long-term pool. And if there is volatility, everything is taken care of. And so we call it, the sleep well at night strategy anyway. So Michael, do you want to go to the next slide? Next, I'll cover reporting and monitoring. We've spent a lot of time over the last 3 years really fine-tuning this, and we've partnered with a company called Adipar that teams with us to provide really good reports and a monitoring system for institutions. And what we are able to produce is our goal is to get reporting simply as simple as possible to the CEO, the CFO, and controllers, and to the governance. And so just a quick example here is a quarterly investment report. It's going to have up at the top left the summary of assets. This is by quarter anyways, and this is an active hospital, but we break it down by the short-term pool, the long-term pool. It's going to show you what percentage of the portfolio is where, what's the starting value and ending value. It's going to cover the current returns, going to cover the current asset allocation, and it's going to go over the change of value over the last 12 months. And then we can go longer and show what do the pools do over the long term. A lot of times we see reports that really can only go back a year. They don't really they change strategy, so they can't connect the dots, and they can't show how decisions have either benefited or subtracted over the long term. And then we'll break it down into the different pools and show you cash flow. We have 1 year projected and 3 year projected to see what bonds are coming due, what's maturing, what's the income coming off of the portfolio to fund different needs of the institution. Then lastly, or second, we'd like to provide a monthly report to the CFO or the controller to really summarize what happened in the investment portfolio so they can explain the different results as they need. And so we'll do something similar. We'll take the short-term pool and the long-term pool and show what happened during the quarter or the month. We'll explain what the returns are, but importantly, we'll also show what the market did or a blended benchmark, and we will match what the institution's results were, what the broad market's results were, and explain any differences that need be. One of the coolest things I think we've stumbled upon over the last 3 years is working with auditors to try to connect. How can we help the institution and help the CFO and the controller really make it easier to reconcile the statements to what is reality? And so we've created our own journal entry process to show and to reconcile the differences. Because all statements, you probably know this, but all statements don't show the correct information all the time. A lot of times, what we find is if it's at the end of the month and a dividend hits or interest hits, a statement will recognize the income, but then they'll also keep it as accrued income. And so you're doubling up as income. And so it's overstating what the value is or what reality is. And so we try to marry that. And then we do that month by month and create a quarter view to send to an auditor. And then we match up 4 quarters to the year. So it makes that annual audit process very easy. And because we've already discussed and built the answers.
Yeah, so that kind of wraps up the investment operation, a number of the pieces, a number of the elements that are necessary to have, we think, a well-functioning investment program for business number 2. Now let's transition into some investment options, opportunities that exist in the marketplace at the present time. This is a slide we've borrowed from JP Morgan. In green is equity returns, blue is bond returns. And on the left-hand side is 1-year returns, and this is a bandwidth, right? I mean, 1-year equity returns have ranged from 47 to -39, and it's like daily weather. It's unpredictable. But as you move to the right, and as time goes on, there is more predictability. It's like climate at the end of the day, and you can see the 6% is the bottom end of the range for a rolling 20-year return perspective. So as we think of asset strategies, we really kind of put them into 3 buckets. This represents largely the pools at the end of the day, because each pool has only certain assets that are appropriate to manage and mitigate the risk that need to be managed and mitigated for the job that they're trying to do. Obviously, bank deposits, daily liquidity, you don't want volatility, access, etc. But then for short-term asset strategies, it's going to be income-based instruments, generally 1, 2, 3, 4 year, maybe in maturity, or variable based. And then if one has the opportunity to have a long-term pool and wants to invest in equities, business ownership represents that asset class. This is a yield curve slide in terms of blue being where interest rates, as represented by Treasury yields, were at the end of 2021. And this, each data point represents short-term to long-term, left to right. So 1 month is on the left-hand side, 10 years is on the right-hand side. And the blue line graph would be considered a normal shaped curve. It's low, and it has been low for quite some time. With what's been shaken in the inflation world, interest rates have gone up significantly, and that's now represented by the green curve at the end of 2022. And the green curve is inverted. I mean, the 6-month Treasury is yielding 4.6%. It's actually yielding 5% today, but as of at the end of last year, 4.8%, and that's much higher than what a 10-year Treasury is yielding. And so we'll spend a little time thinking about cash or excess cash strategies or enhanced cash strategies. And first and foremost, it's all about ensuring liquidity without credit risk. And so I wanted to give an example of the Magic Fund that some hospitals in Minnesota may be familiar with, but this is a program put in place for government, city, county, hospitals, etc., to give them some investment option. And most people think that there is no credit risk in the Magic Fund. But when you go to their website, this is the November 30th latest data. The left pie graph, 76% of the assets are credit instruments. What are those credit instruments? Well, they're company bonds, they're commercial paper, they're asset-backed entities like Fairway Finance or Longship, don't know what they are. But 76% of the assets are allocated to these investments. And so it is not a risk-free option that can exist. And if we look at the yield at the end of November, it's 3.9%. The cost of owning this is about 0.35% of assets. But then when you compare it to other options, better options in our mind that exist with no credit risk, treasuries, government bonds, and you can see, 12-month Treasury yielding 4.6. This is as of February 1st. A 12-month government agency bond again, risk-free from a credit perspective, is yielding 5%, significantly more than what's available through that pooled investment vehicle. So there's a couple slides on cash, excess cash management strategies. When we talk about income investing, the importance is about duration and is about strength of credit. And duration is how far out on that curve is one going to go. The most commonly used bond index is the Barclays Bond Aggregate Fund, which average maturity is more than 8 years. It has a high duration, and it will be exposed to volatility if there's changes to interest rates like what was experienced in 2022. What is more appropriate types of strategies for what we would call the reserve pool and short-term investing are these three options that have certain jobs to do and complement each other in terms of putting together a portfolio that is delivering its intended purpose. And you can see at the end of 2022, in terms of where their yields were sitting and what the duration or average maturity profile of these three strategies, all on the short end of the equation. So they're gonna have limited volatility, they're gonna have high liquidity, the credit strength is excellent, and the yields are at levels not experienced and seen in more than 15 years. And so as we think of specific strategies, going back to the honeycomb, these are examples of specific strategies that could be built to complement and create a fully diversified portfolio. But just wanted to highlight a few elements on the cash management and on the income side of the equation. So lastly, as we have about 10 minutes left, where is one at? The SWOT analysis. This could be an example of 10 questions that you can ask yourself about your situation, your institution, etc. And if there are a lot of I don't know questions, that will, that says you have a lot more opportunity potentially that one can start to unfold. But number 4, will prospective returns exceed the cost of the debt? Is the portfolio stress tested? I mean, there's all sorts of things in here that could be helpful to help you do a self-assessment of your current situation. As we have kind of observed a lot of facilities, most are in one of 3 positions, and depending on where one is at, the next steps of improvement are determined by where one is at. As one is predominantly has all the money in the bank, the first thing you got to do is get beyond cash and get into marketable securities, buying treasuries, buying government agencies, getting a policy in place, doing all those establishing a reporting system. Then we'll work on developing institutional skills. Then after that, and that might take 3, 4, 5 years, right? Then after that, let's work on, sophisticated skills to allow the opportunity to potentially compound return. One of the most important things that will have to be determined is who's going to be the leader. Is it internal? Is it the CFO? Is it somebody else? Is it a consultant? Is there an appetite for a CIO kind of based model and the potential advantages that it can bring? And at the end of the day, the improvement starts with risk management, and risk is such an overused term in the investing world. But if one thinks about all these elements in the proper context of risk management, is about ensuring clarity, completeness, on the policy side of the equation. It's ensuring, appropriate allocation based on your individual needs. And risk management is stress testing, what can happen in the future. If a COVID environment happens again, will you sleep well at night knowing that you have investments that can survive whatever the world is going to throw its way into the future? And as all of those elements, are brought together, that will then determine results. And as Ben Graham best said, the essence of investment management is the management of risk, not the management of returns. This provides a short example in terms of, depending on where one is kind of at, what are some additional steps that could be put in place over the next 12 months to work on improvement and ideas. But as it relates to the SWOT itself, the cost is a couple hours of your time. And there's limited information that you really have to provide that can provide some high level context that us iBailey and Highline can comb through and identify where you're at. And then it'll take about a 45-minute presentation along these lines to reveal the findings. And a part of that is a fee and total cost analysis. And a part of that is executable ideas for improvement. And so to end with the beginning, this started without a plan, but it did start with the idea of always trying to get a little bit better each month, each year, and things eventually compounded to be a pretty interesting result. In closing, these 5 best practices, I think if we could leave you with, are things that are often not talked about in the investing world, in the institutional investing world, and anything that relates to improvement will involve a number of these things, but it's really about risk management done right. It's really about connecting mission with investing. It's really about intelligent investing, and it's ensuring there's a unified set of beliefs that is defined for the organization. And then it's just getting the right team with the right people doing the right jobs. So I thank you for your attention, your time. Appreciate this opportunity that Jeff and the iBailey team has afforded us to share some insight and some opportunity that we know exists on the balance sheet side of the equation.
All right. Does anyone have any last and final questions? If you want to put that in the chat, that would be great. Let me just put this up.
As we wrap up and look for that, yeah, if questions do arise, certainly feel free to reach out to Michael and Casey with any of those questions. If you are interested in a SWOT analysis too, I know they'll be happy to discuss those items or discuss some of the results of your own kind of self-assessment of where you're at on kind of some of the best practices that we talked about today. So,
and we are at the bottom of the hour, and with that, I hope everyone has a great rest of your day and a great weekend. Thank you so much, everyone. Have a great day.